Okay, welcome everyone. My name is Michelle Bridger. I'm going to introduce the topic today. Thank you all for joining us. I'm also just going to run us through a couple of housekeeping notes before we get started. But thank you all for joining us today. As a friendly Zoom reminder, you probably know this already, but you can see and hear us, but we can't see or hear you. So if you have any questions throughout the webinar, please just enter those into the chat function down below of your screen. This session will be recorded and be available to view. We'll share it back with you. The session is available in English and in French. So to access the French or English interpretation, you just need to hover onto your screen, scroll down to the bottom, and you see a little globe that says interpretation. So you can click on that and you can switch between English or French. Alors, pour accesser l'interprétation en français, vous devrez cliquer sur le globe et vous pouvez avoir le webinaire en français. Before we get started, I wanted to take a moment to acknowledge that our Community Foundations of Canada offices and I myself today am on the unceded, unsurrendered territory of the Anishinaabe Algonquin Nation, whose presence here reaches back to time immemorial. We are mindful of a history of broken treaties and of urgent need to work continuously towards reconciliation. We are grateful to have the opportunity to live and work in the community on this territory. We commit to taking care of the land and to the creatures we share it with. If you feel like, you can put your name in the chat and where you're from, and we can get a sense of who's here on the call today. So as that happens, I just wanted to thank you all again for joining us today for this discussion on growing your investor mindset, which is going to be hosted by Kelly Gauthier. Kelly is Managing Director and Partner at Rally Assets. She is responsible for Rally's advisory services and oversees all client engagements. For 18 years, she has worked with a range of asset owners to design and implement their approach to responsible investing and impact investing, strategically aligning their investment and portfolio strategies with positive outcomes for people and the planet. Kelly has advised more than 60 market lending foundations, corporate and private investors, contributing to over 250 million of capital invested in high impact solutions. Before joining Rally, Kelly was with Mercer in the Responsible Investing team, and Kelly is a board member of the Responsible Investment Association. I'm going to hand it over to you, Kelly. Thank you.
Thanks so much, Michelle. It's a lovely welcome, and thank you for having me here today. I'm pleased to see some familiar faces in the crowd and some new faces as well. So I'm excited to have this conversation. As Michelle said, if you have questions along the way, please throw them into the chat. I will try and address them and weave them in real time. And if not, I'm happy to address them at the end. We've saved lots of time for question and answer. So in terms of growing your investor mindset, as Michelle sort of kindly shared with you in my bio, this has really been the work of my career, and helping folks to understand about impact investing and how to create impact with an investor mindset. And so I'm happy to have this conversation with you today. So in terms of some of the context and where we're coming from, so why I'm talking to you, for any of you that are unfamiliar with Rally or our work, impact investing is all we do, and we come to asset management from an impact first mindset and perspective. Our investors and clients are all folks that are looking for impact aligned investing, wanting to understand, both from the earliest stages of the continuum around how do I do this and what does this all mean and how does it fit in with all the other things that we're doing, right all the way through to implementation, to placing capital, and then portfolio management. And we've been doing this with community foundations. I've had the pleasure to work with a number of folks within the community foundation movement, and in addition to private investors and private foundations. And so then, we had a session in September. And so where I left off with that piece, and some of you may have attended that, and it's not a prerequisite for being here today, but that was part of the IRP program. And it was really thinking about what is investment readiness? How do you assess, investments versus grants? How do you leverage your strengths and think about really shifting to that investor mindset as opposed to a more bifurcated, granting and endowment investment perspective. And some of the questions that we left off with in September were around, what are the learnings from the IRP program for those of you that have participated in it? And even for those that haven't, there's a commonality of wanting to understand how to use different pools of capital in different ways and how to extend your impact and really use all the tools at your disposal. So how do you envision your community foundation as an investor in either a local business or as a lender within your community? And then what are the gaps that exist for you? And so starting to think about these types of questions allows you sort of really a launch pad. And I hope that that's part of what you've been noodling on for the last little while and hopefully part of why you're here today. So we're going to start with a little bit definitional and really unpack the impact investing definition in terms of how it's applicable in this context. And so some of you may have seen sort of the textbook definition around impact investing and its relative position to responsible investing. So responsible investing is an overall approach to incorporating ES&G factors into your investment decisions. And that may mean just from a financial risk mitigation perspective, or it may be more intentional. Impact investing specifically is really an intentional desire to create positive impact in environmental and social factors. And so, alongside with a financial return, so we're not talking about concessionary investing necessarily, and with a measurable perspective on it. So, the textbook definition talks about both the investee and the investor measuring those impacts. So if we start to break that down a little bit and kind of pick out some of the different pieces. So with respect to impact specifically, we have, the impact is really all the changes that come from a business. And so not just what that business does or sells, its products or services, but also operationally. And everything has an impact. It may be positive, it may be negative, it may be intended or unintended, but really it's unpacking all of those activities in the supply chain, in how staff are managed, and in the outputs, and understanding what the impact of that is. And so when we think about that, we consider, what the change is, who's affected, where they are, how much change they're experiencing, over what time period and the duration, whether that change would have occurred anyway. So maybe the change, and the change in its connection to a certain enterprise, maybe they're a bystander to that change. What is the risk that that change does not occur? So if this change that you're hoping is going to happen doesn't happen, what happens then? And then how is that change made? And so these are the fundamental, underlying parts when you think about impact, and that lead also really naturally into impact measurement and thinking about it from an impact measurement perspective. So the second part then on the impact side is the social and environmental piece. And I'm sure all of you are familiar with the Sustainable Development Goals and perhaps are using them in your own communities and in your own work on the granting side. But the SDGs have really provided this great matching mechanism on the investor side as well, to be able to think about this, $5 trillion that's needed annually to meet the SDGs, and understanding that it's not going to all come from charity and it's not going to all come from government. So where does that capital come from then, right? And so you may be working on those SDGs with your philanthropic capital, but how can you use the rest of your capital to align? And if you are using the SDGs as a framework on the granting side, then it also allows you a pretty natural extension to think about how you continue to align your investment activities with the frameworks that you set up on the granting side. So the next part we're going to pick apart is really around measurable impact. And so again, this is in the definition around how is it measurable and why is measurement important for you as an investor. So really impact measurement wants to look at what are the changes that occurred, when, why, and how. So the same dimensions that we talked about under impact. And really that measurement is key to understanding if you're having the impact. to be able to efficiently mobilize your capital and then effectively engage with those different priorities and do it better over time. And, sort of more specifically for you, it's really about understanding, why you should do this is around, did you achieve the change that you are seeking? Have you proved your thesis? To understand what sort of impact is occurring and how your investments are contributing to that impact, is the thesis that you set out when you go about doing this, and when you pitch this to your board and work with your investment committee to change the way in which you're investing. Secondly, is from a portfolio management perspective. So understanding that ongoing active management is required for the best impact outcomes, right? So how do you efficiently allocate that capital, not just the first time that you start to do impact investing, but over time and as you continue to make additional investments. So to say, and your investment committee and your board and your other stakeholders should be asking you questions around, are these activities and these inputs going to lead to the impacts that we want to seek, just in the same way that you would think about it within your granting dollars. And so then the last sort of really fundamental piece is around your mission and alignment of your assets to that mission, which is the purpose for doing this, why this makes so much sense for community foundations and others who are purpose-built organizations, to know that you're achieving your mission and that you're contributing to that mission with as many of your tools and assets as you can. The last part of that definition is around a financial return. And so without going into, there's a ton of research now that's available, a ton, on returns, on sizing of the market and all these different pieces, many of which are available on not just our website, but also Foundation Investing. And that research is showing that, there is tremendous momentum with respect to return. So funds that, this is just in the last year and in 2020, when goodness knows a lot of other things were happening, and not just the financial markets, but in the world. But that returns on sustainable funds, on impact and responsible investments, were outperforming their non-sustainable and sort of not responsible peers. And so this has been great sort of fuel for this sector that has been growing at a tremendous rate already, and helping to give investment committees and trustees a much better sense of confidence about making decisions to start to allocate capital in this way. Because investors are finding that actually this is a really great place to find opportunity and to find outsized returns, and that the types of businesses that are aligned with an impact and responsible approach are actually the ones that are really well positioned to succeed in the future, right? And thinking about those future indicators of success, not just past indicators of success. Okay, so why should a community foundation consider impacting and impact investing, and why are you well positioned to do this? So what if you leveraged all of your assets to accomplish your vision and your mission? What if you stop seeing your investment portfolio as something that is distinct from your mission and instead aligned your activities to it? Thinking about that split between the 3.5% that you grant versus the other 96.5% that is invested, and thinking about your allocation of time in the same way, your time and your resources. And so what if you started focusing a bit more on the full body of your assets and not just your granting portion? And that's really where the ethos of impact investing comes from. So impact investing, is really relevant for foundations and can create a lot of benefit for foundations. And so thinking about it from this lens of, impact investing should complement your philanthropy if it's properly strategically integrated into your philanthropy, so that you understand what you're doing on the philanthropic side versus what you're doing on the investment side, how those two work together to achieve your overall impact. Investors of all sizes are needed. And so we often hear from the foundation community, as well as from individuals, that I don't have enough capital, my endowment's not big enough, I can't allocate enough capital. But really the support for some of the smaller funds and products, especially at a community investment level, maybe even more important, right? I was in a meeting earlier this week with a community foundation who was talking about how their capital into a large, global fund, it's not additional. Their capital is not going to make a difference into that fund, but a small portion of their capital into, a local enterprise or into funding, a local, let's say a museum for an arts organization, right? That capital is going to matter in a place where other capital may be more scarce, versus into bigger pieces. So don't be deterred by the size of assets. There are lots of opportunities across the spectrum, both big and small, where your capital will be valuable. And the last part is really around learning. Everybody can do this. This is, you have the different tools, and we'll talk about that more a little bit as we go on. You have the tools within your organization to figure out how to do this, and there's support out there, whether that is your, existing investment consultants or managers, or other folks that are more specialized in this space, like Raleigh. So in terms of benefits specifically for your organization, so obviously this provides you with greater resources to be used towards your mission. I mean, capital resources, right? So you can do what you can do with your granting budget. You can build partnerships and other relationships that help you to leverage your skills and your community knowledge. But looking at that other, much bigger pool of capital opens up different doors for you in terms of working towards your mission. Secondly, it's going to create greater coherence by allowing your endowment with your values. And so, and this really ties into that third point around engaging a wider set of donors and trustees. So creating that, that integrated feeling when you think about how all of your assets within your community foundation are aligned to the outcomes and the mission you have within your community, provides not just sort of that integration and alignment sort of from an external perspective, but from an internal perspective in terms of how your staff are aligned to all of your activities. I think we're also seeing from a donor perspective that donors are starting to ask questions about endowments. They're starting to ask questions about how your assets are being stewarded. And certainly as you think about the next wave of your donors and what your future engagement of donors looks like, we know, and there's lots of research and evidence around millennials and younger folks being, very mission driven, right? And so they are not only, aligning their values with where they work and how they behave as consumers, how they spend their money, but also where they give, how their assets are invested, and they're becoming much wiser and more educated around these issues. And so thinking about that future donor engagement perspective, this alignment makes a lot of sense and really resonates with that group. Next is that it's going to mitigate reputational risk. So this is a conversation that is happening around a number of tables, and a number of trustees are really concerned about what it is they might hold that they don't know, and what that alignment looks like for them, and what that would mean if any of those investments were revealed that were misaligned with their mission, misaligned with their values. And so understanding what you hold in all of your portfolios, understanding what that alignment is, and being intentional about at various levels how you do that is important from a reputational risk perspective. And then the last piece, tying into that financial risk piece, is around better risk adjusted returns. So not only looking for outsized returns and better returns from future economy types of companies, but also mitigating against, exposure to non-correlated assets and looking at long-term diversification in your portfolio. So this triangle talks a little bit about the systems change perspective and how these pieces that I've just been talking about kind of come together, right? So from the base of that pyramid, thinking about minimizing harm, right? So that your investments don't negate the impact that you're having with your granting and your program activities, and making sure, again, that integration, that connection exists. As you take it up a level, you're looking to amplify your impact, so a bit more positively focused, so not just risk mitigation, but positively focused around making sure that your endowments are delivering not just financial return, but also positive impacts that would be aligned with your values and aligned with your mission in your community. A level above that is really around strengthening engagement, engaging a broader array of stakeholders, whether those are donors or other partners, and into more meaningful conversations, thinking more creatively about how you can use your investment capital to make different things happen within your community. And all of that really feeding into that systems change perspective of, and I think for community foundations, really sort of scratching that itch of, we're working so hard in our communities and we're deploying grant capital and we have all these programs and all these pieces, but the problems aren't going away, right? And fixing these problems is still going to take a lot more capital and a lot more time. And so starting to chip away at it a bit more from a systems change perspective. So practically, how do we get started? What do we do here? Well, the good news is that you have already started. You are here. You are thinking about the difference between grants and investments. You're thinking about what skills your team has and what skills they lack, where those gaps exist. How your organization feels about impact investing. And so, I heard this quite a bit in the conversation in September and with other community foundations that we deal all the time. So really identifying where you have champions, where you have skeptics, and every organization has a healthy combination of both. But what is the appetite for doing this type of work? And what your community need is, right? So one of the things that has been an interesting outcome of the IRP process has been for community foundations to see, if they had the opportunity to say, who needs different types of capital, what type of investment readiness, where are you at in terms of your maturity, what types of enterprises are out there for us to fund. Many community foundations had an innate sense of that, but really putting a call out in the way that IRP did allowed you to test that a little bit more and understand what that need was, what stage it was at, and start to think about how you can respond to that. So that is a great first step. Next is to think about leveraging your strengths, right? So you know your community better than anybody. You know how change making happens and how to create impact in your community. You know where the gaps are, you know who's serving what needs, whether that is your organization or others, and you know where needs are not being served. You know what type of interventions are working and what types aren't. You know how to assess those change-making organizations and initiatives that are happening. And you know how to attract funders. You know where capital is going to come from. And so that's really an excellent foundation for thinking about that with an investment lens. So the questions that are outstanding for many of you are really around, how do we engage differently with our community? How do we support more organizations? Do we have the right expertise and capacity? How do we know what we want to invest in? Is it the same types of things that we grant in, or are they different? And how is impact investing integrated into the rest of our work, whether that's the granting side or the way that your portfolio is, your endowment is invested today? How do we find impact investments, and how do we compare them to each other? So what's the process for deciding around an impact investment? And then how do we monitor and manage those investments? And so that's really, those are kind of the core pieces around starting to break down a strategy and approach and a way of doing this. So the impact investing roadmap, which some of you may have seen before, is something that came out of Foundation Investing 2.0 and is in the guidebook. And so these materials are all available on impactinvesting.ca. And so the guidebook that was developed a number of years ago with Rally and community foundations and philanthropic foundations was really about helping foundations to get started, to understand what this sort of meandering path you see in front of you looks like, and where you start. And the reality of this path and why it is a squiggly line is that it's not a linear path. And trust me, nobody starts at step one. Most people actually start at step 7. So they will start with an investment that either is, a past grantee or an organization they know well in their community, or that, a member of staff or a board member is involved in, and bring that to the foundation to say, this is a really cool thing. Can we do this different thing? Can we use our capital differently? What pool of money would we use? How would we do this? And so with that test type of mentality, then starting to think about kind of 1 to 6. And so regardless of where you stop or where you start, my experience has been that most foundations will then eventually make their way back to step 1 and say, okay, we've done some testing, we've done a few different things. Some have worked, some haven't worked. But if we want to do this in a more meaningful way, we need to be more methodical. We need a vision. We need to create buy-in and governance. We need a proper strategy that talks about what we're doing, why, and what we're not doing. We need to figure out how we're going to measure it. We need to figure out what the implementation plan is. Who's going to manage all this? Is it going to be staff, committees, external help? And then start to place more capital. And so that route is very normal in terms of it's kind of bouncing around. So within the guidebook itself, you'll find resources on each of these steps, some of the questions to ask, the way to go through this and about it. And certainly I'm happy to answer any questions on this specifically, but I encourage you to go and check out this piece. So what I'm going to get into is a little bit around sort of some of the key components of this approach, and how you start to break it down. Not the full thing, but some of the key pieces. And so theory of change is an exercise that many of you are probably quite familiar with from your granting perspective. And so we like to use it from an impact investment perspective to think about not just how do you kind of parallel process your theory of change a little bit with your granting activities, but thinking from an investor's mindset, how do you go through that input, activities, outputs, outcomes, impact chain to think about how you look at it as an investor, right? So from the bottom up, what are the resources that you need to achieve those, to put into those inputs that are going to drive activities and outputs to outcomes and then to impact, to understand, where you start and what you're looking to achieve. Because the path, as you have found with, your tremendous history and depth on the granting side, is that your path from inputs and activities to impact is not always linear, and it's not always the way that you expect it's going to happen, right? And so there's iteration in that. The same is very much true on the investment side. So the next piece that we then take from that, once you have a sense for the outcomes and impacts that you're seeking, is really a bit more specifically around themes and population. So wanting to think about, and for community foundations in particular, there's an overlay of geography on this, right? And so you may have a very broad thematic alignment for your mission and the way that you act in your community. And many community foundations do, but others also have specific issue areas that they're focusing on, specific themes where they have focused their granting activities and where they feel like they have the most potential to create impact. And so it's about thinking about those different themes, aligning them to the SDGs, if that's the framework that you use, and then also crossing that with populations. And so this population lens piece has been gaining popularity over the last few years, because understanding the types of populations that you want to impact, maybe some more so than others based on other equity factors in your community, and thinking about how you do that intentionally, so that as you think of, and so where this heads is that as you think of an investment and you start to think about decision making around looking at different investments, saying, well, investment ABC actually fits specifically for affordable housing for refugees and new immigrants. And so it sits in that box. And now I understand that this is where this sits for me, and that's a priority area for me. Great. And as I start to then think about the next one, I can think about whether the next one reinforces that same box, checks the same box, or whether I want to spread my capital around into some different themes in different populations. Investment parameters need to go hand in hand with the impact themes and the theory of change. So in understanding the impact that you want to create and how you break that down and how you think about it, in parallel, you need to think about your investment parameters, because after all, these are still investments. And so the types of questions that you ask yourself are going to be similar to what you look at on your regular endowment, and similar to, a know your client and an IPS process that you would go through with your endowment, but with a slightly different pivot, right? And it depends on how much capital you're talking about, whether, again, it's sort of a singular investment or more of a total portfolio approach. But you really want to think through your risk and financial return, liquidity and exit, and portfolio management. So understanding what types of investments you want to make, how much risk. Risk relates to structure. So what types of structures or asset classes you're interested in looking at. What is the financial return that you're looking to achieve? And, how does that relate to the rest of your portfolio? I can tell you that in most cases, investors will have the exact same return target in their impact portfolio as they do in the rest of their portfolio. Other investors sometimes choose to have a concessionary return on their impact portfolio, but for the most part, people are looking for the same return out of both portfolios. With respect to liquidity and exit, so do you need income from these investments? And again, these questions have implications for then what you end up looking at. So if you look at a private equity investment that's going to have a long lockup and not throw off any cash in the meantime, what is that going to mean for your overall endowment? Is that something that financially aligns with your goals? And then on the portfolio side, really is around concentration. How big or small of an investment are you looking for, and how involved do you want to be? And so when you think about all of these questions, usually, when we work with clients through this process, many of them will sort of say, oh, like, I don't know, we don't know the answer to all of these questions. And so what we try and think about is, where are the fixed points? Because some of these parts you will have an opinion about. Some things you'll be, very open-ended on, and other things you'll have more constraint. And so thinking about it from that perspective is often helpful. The things that I must have, or the things that I can't compromise on, versus the things where I don't have a particular, we're open to a variety of options. And then that helps you to build that, that set of investment parameters that's going to work for you and that's going to be aligned. And then obviously you want to reflect those along with the investment themes and the impact side of things in either, a specific IPS or aligned in your main IPS. The last thing I'll say here too is that all of this sort of leads into staffing and implementation and governance, right? So if you choose to, from an investment perspective, choose to look at a venture portfolio where you want to have higher involvement, do more community investing, obviously you can imagine that the implications for that from a staffing and implementation perspective are very different than if you're going into kind of large global funds, right? So how you think about it from an investment piece needs to be integrated and working together with how you think about implementation and resourcing. So the last piece in this section is really around governance. And so often investors will start with governance and feel like they need to get the governance piece right off the top. My experience has been that that the best way to move through the governance piece is actually to establish a shorter term working group that's going to focus on, kind of all of these questions and rolling this out. And then once you know what your strategy looks like and how you're going to be an impact investor, then pick the right governance structure for you. It's obviously going to depend a bit on the size of your organization, the complexity of your existing governance structure. But really, these three different models you see in front of you talk to the integration of the IIC. So the IC is your impact investing, or is your investment committee, and the IIC is your impact investing committee. And so you may choose to have an impact investing committee, or you may not. In the first model on the left, you see them in parallel, where the investment committee has probably its existing set of requirements and responsibility, and then the impact investing committee has a specific sort of carve out or set of responsibility. PMs are your portfolio managers. And so that's what you likely have today managing your endowment. You may have one portfolio manager or investment manager, or you may have, two or three. The middle one, the impact investing committee, is a subcommittee of the investment committee, and that allows that committee to do its work on its own, focus on this new different thing while they sort of get it up and going, but yet still bring the investment committee along on the educational ride, right? And have the investment committee still have accountability for, either making final decisions or ratifying them. And so there's value in that in terms of making sure that the entire chain within your organization is learning, is growing, and is starting to figure out how this works. And then the last model really is just your investment committee. And if your investment committee has the capacity and interest to take on something new that will take more time and is probably not in your current terms of reference, then great. If that's what the mandate of that committee is open to exploring. And so those are really kind of the different approaches, or the most standard different governance structures. Okay, so a bit more on implementation specifics. So most people jump right to, how are we going to find the deals? So how do we find different investment opportunities? How do we build a pipeline? The traditional approaches really are around looking at your existing grantees and your charitable giving. So where is, maybe there are folks that you have granted to in the past that are looking for different types of capital, and really going to that network of folks that you are working with currently to create impact in your community. The impact investing sector itself has grown tremendously, and there are a number of events and conferences and different associations as well that are happy to fill your inbox with newsletters and information about what is happening in our market, not just here in Canada, but also globally. And so some of those events can be really valuable for helping you to contextualize what's happening in the market. Investment advisors. So talk to your advisors, talk to your portfolio managers that you have today, talk to your investment consultant. They may or may not be interested in talking about impact investing. And then you can go from there, right? So understanding kind of what they can and are interested in doing for you and what they can't. Many traditional portfolio managers and investment consultants haven't built up a ton of depth on the impact side specifically. They're all working through ESG integration and responsible investing at various levels of depth, but many of them haven't tackled impact investing yet. And so this may be something that is not within their scope, and that's okay. Then you start to look at who are some of the more specialized advisors and consultants and asset managers that are working in this space, and how can they support you in various ways, from a consulting advisory type relationship to full asset management. There are some databases such as Open Impact, which we manage, the SVX and Front Funder. The databases are not going to be your silver bullet. They are not at the level of sophistication that you would find in the public markets, for example, but they are a great place to sort of start your hunting and snooping around the types of opportunities that are out there. I think this is probably one of the need areas for the space, and one that a few folks are kind of focused on right now, is how do we bring some of those databases up to having more comprehensive listings on them. And then the last one on there is just around networks, associations, angels, and even sort of specific groups like SHEO and the 51 Fund, who are working really hard within their sort of various circles to start to catalyze an investor conversation and be able to educate investors and bring them along. But more specifically in your community, so going back to those of you that have participated in IRP, and even through all of your other activities within your community, you already know SPOs that need capital, that have come to you with different requests, that have come, in through whatever different avenue, looking for you to engage with them differently and support them. You now have, for those of you that have done IRP, you have a ranked list of organizations that you've reviewed, an understanding of how mature that list is. So how investment ready they are. Are they really early on in their journeys, or are there, a number of them that you would have liked to have funded and didn't? The ones that were funded, and where they're headed next. So that's a pretty robust starting point from a community investment standpoint. Those are folks that you granted to with the idea that they were going to become investment ready. So thinking about how you use that list, how you track them over time, as they become more investable and as they get to that actual investment readiness, is a really great place to start. And then extending that to think about, okay, how do you do this on an ongoing basis? So we have this starting point, and as we know, any list of data is only current the minute that you've finished it, and then it starts to become outdated. So how do you keep that up to date? How do you think about how you engage within your community and with SPOs in the future to say, okay, well, how do we start to curate this pipeline? If this is something we want to do, if we want to use our capital in this way in our community, then how do we manage this? How do we start to build that pipeline over time? And so then I want to really just remind you towards the end here of thinking about using all of your assets, because there are really different ways, we can swing here between, community investment and local investing, and how do we do that, all the way up to, your endowment, your investment managers and your portfolio managers. So when thinking about the different ways that you can use all of your assets, this framework's often helpful to think about investment selection. So what are you choosing to invest into, whether those are big global funds or, impact private equity funds or small community investments? What are you choosing to invest into? And who are the folks that are helping you do it? So what's the investment manager oversight on that? Do you have, the relationship, and have you communicated to all of your investment managers, regardless of which asset class or what their mandate is, what the alignment to your mission means to you and what you expect it to mean to them in terms of how they implement their mandates. And then having that be an open and active dialogue. So you likely have presented those investment managers with an initial mandate. When you contract with them, you probably meet with them quarterly, review some financial returns, but really starting to press them on some of these issues, understand the things that are in your portfolio, why they're there, and make sure that you are happy with what's in there and that the alignment to your mission is something that you're proud of. Stewardship is an area we haven't actually really talked about at all today, but stewardship is around how do you use your ownership in listed equities to advocate for change. And so are your investment managers, likely it's your investment managers, not yourselves, that are doing that, but are your investment managers doing that on your behalf? Are there opportunities on particular issues that you care about for you to have a bigger voice, for you to be more active, for you to engage in collaboration with other investors that have the same issue focus, and to think about from a proxy voting, policy advocacy, and shareholder engagement perspective, how you can use that power that you have for good and to change towards positive impact. Partnerships, you understand incredibly well around how you use your human capital, how you use your voice and your stance in the community to bring folks together to make good things happen, right? And so thinking about that from an investment lens, not just from a granting lens, can be really powerful, right? So as somebody that holds capital and that has stewardship over that capital, how can you make different things happen in your community and contribute to that in a different way? And then lastly is your philanthropy. So using your granting and donor capital as you are doing to create change in your communities. And then the last piece I'll leave you with here, and then eager for some questions in the chat, is really around learning. And so attending sessions like this, Foundation Investing 2.0, as I mentioned earlier, has a lot of great resources on it. It is designed specifically for the foundation community. And there are lots of bits and pieces in there that are useful in terms of how do you engage with your board, your investment committee, bring folks along. There are case studies and interviews and other pieces. We have a newsletter that you can sign up for, where you'll get other content from Share and Rally, who run this program together, around things that are happening in the sector, things that we think are important for you to pay attention to, and other events that are coming up. So I encourage you to keep learning and bring your trustees and your staff along on that learning journey with you. And so with that, thank you for having me. I really, really appreciate the opportunity, and I'm happy to answer any questions that you have at this point. There's one already from Anita asking, can you give more examples of how you can negate impact from program activities, aside from the obvious giving all your endowment away or losing it without proper due diligence? Okay, so I'm going to take a stab at this, Anita, because without the ability for us to chat, I'm going to make an assumption at what it is that you're asking and answer it that way. So I think what you're asking is, how would you negate the impact from your program activities with your investing? So what is an example of something that would be counter, right? So for example, if you care about decent work in your community, if you're working on issues of decent work, then what you want to understand is how your investment, so you can be doing a whole bunch of either advocacy or programmatic work on the decent work piece of things. If you're not aligning that with your investment portfolio, then maybe you're invested in big organizations like Walmart or others that are paying a very, below a living wage, that are not treating their employees with respect, that don't have proper benefits, that aren't We saw a lot of this at the beginning of the pandemic around different organizations and how they chose to treat their employees when they were under, a lot of uncertainty and financial stress. And so wanting to link those two things together in a way that you feel confident about what your mainstream investments are doing related to your programmatic work is sort of what I'm talking about, right? So that's the risk around that. And so understanding, at the end of the day, hopefully your risk perspective is sort of more beyond the headline risk, but there is certainly headline risk here of if your community newspaper, published a story about programmatic work that you were doing in your investment portfolio, that's the headline risk. Hopefully all of us are more deeply embedded in terms of actually being concerned about the actual risks and what that means. So I hope that answered your question, Anita. Great, thank you. Any other questions from the audience?
Want me to give you a break and I can read the questions to you, Kelly?
Thanks. Yeah, I think we've got one more here. I'm okay. I got a sip of water there.
Okay, go ahead.
So Aaron's asking, my inclination is to not break down potential investments by theme because our overall theme is community well-being. Any issue with that? No issue with that whatsoever. I think when I talked about that, so within the community foundation space in particular, there's quite a range, right? And some community foundations do exactly what Aaron is talking about in terms of being aligned to community, and that's the theme. And I think I was going to say that it actually depends a little bit on size, but I've seen the same thing happen in smaller foundations and also in much larger foundations. So I think aligning to community is perfectly fine. And the same may be true on the population lens piece in terms of wanting to affect inequity at a larger level and all populations. But there is certainly room for folks to focus on specific themes, specific foundations, and maybe those are the issues that are more pressing in their community. So no concerns with that. I will touch on geography a little bit here now that we're talking about it. Because for our community foundation, one of the most common questions that we get from a community foundation perspective is around a focus on geography, and that if we're doing impact investing, it must be within our local geography because that's what our mission is. So we need to do it all within our city. And I think there's a few different approaches to doing that. So certainly there are community foundations that feel that's where they want their impact to be. The thing about an impact investment is that it does sort of sit very structurally between your granting work and your endowment, right? And so for your endowment, it's global. It has no alignment to your local community necessarily, or no requirement to be aligned to your local community. Your granting work is very, very community driven. And so the thought of an impact investment is, the granting mindset will say, well, it must be in community. The investment mindset is, well, it can be global. And so thinking about where that fits and what the right answer is for your community and for your group is a really worthwhile exercise. There's a layer of practicality that gets sort of layered on top of that. And where I think where most foundations land is that we would love to invest in our community and we want to look for local investing opportunities. That is one skill set, investing locally and curating that pipeline and being able to manage those investments. That's one skill set, and it can be a lot of work, and it might be skills that your foundation doesn't currently have. Investing in funds or more sort of structured products is maybe easier, but it's likely to be as community aligned. And so many foundations have taken the approach of trying to do a little bit of both, or starting on one side and then working into the other, understanding that when you invest into more structured products or like national or global products, that you are still having the impact that you're seeking, that it's aligned with your mission from that perspective, and that you're building an ecosystem. So it's more of a catalytic positioning. You're building an ecosystem that will then trickle down and have impacts in your community. And if you have the capacity or the interest or ambition to do community investing, then also starting to build that piece up so that you have a focus within your community, but that you also have an ability to deploy capital maybe more quickly or more easily into a structured fund. So hopefully that's helpful. We have another question here. So a copy of the presentation. Michelle, I think you're going to make it available.
Yes, absolutely.
Great. Okay, and then we have Anil. So Anil is saying this question. Oh my goodness. Sorry, Anil. Just reading. Okay, so curious if you are seeing Black or other persons of color communities trying to get into the impact investing space as investees. Are they facing more barriers? If so, what can we do to help them? I didn't ask about Indigenous communities specifically because seeing that the Circle is involved gives me confidence. Thanks, thanks, Neil. Yeah, the Circle has been a partner in foundation investing since the beginning, and they are an Indigenous-led and focused group that helps to connect philanthropy and different philanthropic endeavors to activity in the Indigenous space and also an Indigenous awareness and perspective. So they've been a really valuable partner in this work. So with respect to Anil's question, we are seeing, so there's a few ways to look at it from, within the lens of anti-Black racism and other Black and POC communities. So we are seeing some movement in terms of as investees. In the foundation space, there hasn't been a big growth in terms of Black-led foundations or POC-led foundations, or ones that are maybe culturally aligned. Certainly the Black Opportunity Fund is likely on many of your radars, and they have a tremendous amount of momentum and ambition with their mandate. And so their mandate will be to not just grant, but also invest into into Black-led and Black-serving enterprises. But beyond that, we're not seeing a lot more. So what I'm not seeing in terms of barriers and how we can help them, Anil, is that what I'm not seeing is the collections of that capital as issuers of that capital. We are definitely also seeing, while there's a tremendous amount of interest in investing into different BIPOC strategies, we're not seeing enough of them on the ground. And I'd say that from a pipeline perspective, there's not enough of those types of strategies for folks to invest into either. Hopefully that is helpful and answers your question. There's a question here from Kim. I was wondering how could you tie contingency funds with impact investing, those funds that are used to separate risk of investments, i.e. stock market returns. So I think what you're talking about is just public equity. So I can tell you a little bit about Rally's approach. So impact investing can be done across all asset classes, and that is not just sort of baked into the GINS definition, but also practically where the market is at globally. And obviously it means different things in different investment, in different asset classes in terms of how you implement it. The level of depth, whether you can think about it a little bit in terms of a breadth versus depth perspective. So in the public markets, you can invest into a public equity, whether that's small cap or mega cap, that has an interesting impact thesis, that is doing things to change markets, that is doing things to drive impact and change systems. Your capital is likely to be, I think I made this point earlier, but your capital is less likely to be additional. It's not, your particular dollars are not going to matter to that piece, but the growth and support and leadership of those firms as they, continue to grow and their valuations increase means that whatever impact they're having in their sector and in, globally is going to have more momentum, right? And so that's really the breadth. You're going for, in public equities, you're going for breadth and thinking about, deep impact pieces. In private equity, it's more about depth. So you're going to have likely less reach in a private equity investment or in a private equity fund. You'll invest into a number of underlying holdings. Same would go for private debt. So you may be investing into a portfolio of affordable housing buildings, and there may be a specific 10 or 20 buildings. And so that is going to be very targeted impact in a way that you can understand. but it doesn't have the same breadth, right? And so it's really that balance. And that's how we think about it, is looking at it for investors that have different interest and different ability or capability from in terms of where they can place their capital. If you want to look at your entire portfolio from an impact lens, you absolutely can. You can do it in in public equity, you can do it in fixed income, you can do it in alternatives and private assets. There is absolutely a way to do that. And I think there are some really great examples of folks that have done that. If you're not familiar with the Inspirit Foundation and Jory Cohen's work there, I would encourage you to check them out. They not only have a commitment to 100% impact, but they've been really intentional about how they built out an impact investing portfolio that started with private assets. And then they've gone through and readjusted their entire sort of traditional portfolio on an asset class by asset class basis. And in some cases designed new products with investment managers by going to them and saying, we want something that is really intentional and impactful. And so they've kind of done it that way. I hope that answered your question, Kim. Whose organization that was? Okay, so that's the Inspirit Foundation. They have lots of information on their website that talks about not just their approach to 100% impact, but also how they're measuring it and other pieces. And thanks, Duncan. Yep, that's the one. Any other questions? The chat seems to slow down. We're almost out of time. Well, I'll leave it to Michelle to wrap it up if there aren't any other questions. My email is up here. And so as the folks at Community Foundations know, and some of you, I'm really happy to connect directly if you have any other questions or didn't understand something that I've said. Please just reach out directly, and I'm happy to see if I can help to clarify that for you. And thank you so much for your time and your attention.
Thank you so much, Kelly. That was full of great information. I learned some things myself, so thank you so much for that session. And again, it's going to be shared on our website, so we can share that out with folks who weren't able to make it to the session today. Before we leave, I just wanted to take a moment more of your time to fill in a quick poll just to see how you found the session today. It always helps us kind of build future programming. And so you'll see it on your screen in a moment. And then I just wanted to say thanks again for joining us today. I know there's been a lot of webinars recently hosted by CFC, so thank you so much, everyone, for making the time for this important conversation. Thank you.
Thanks, Michelle.